What is an S Corp? How does it apply to me? Will it save me money? Do I have the right entity structure in place? How much would an S Corp save me? I'm going to go ahead and answer those questions today in this video. So my name is Kevin Andrade. I'm a CPA licensed in the state of Maryland. I operate my own tax advisory firm, Spark Tax Services. I have over a decade of accounting experience. Our ideal clients are usually business owners profiting more than $300,000 or W-2 earners who are making more than $500,000. Yes, we help both. And our focus is mainly proactive tax planning and advisory. Yeah, we can do your tax prep, but we like to think more proactively and go long-term thinking and not only just saving taxes, but creating wealth and generational wealth for you and your family. So that's ideally what I am doing. Now, in this video, I'm going to be going over the S Corp. And the S Corp is those for, it's a great foundational strategy. We call it a foundational strategy because for our clients, we like to set up a solid, strong foundation before going to advanced strategies, right? So S Corp is one of them. Fantastic strategy. My own company is an S Corp. Love an S Corp. And then so I'm going to break it down today for those that are, self-employed, specifically for business owners that are considering an S Corp and whether that makes sense. And let me know what you guys think about this new style of video. I'm going to be sharing my screen and breaking it down on my iPad, on my whiteboard on my iPad. And so if you want any other strategies that you can think of, drop it in the comments below. Feel free to subscribe. I'm going to be going over various types of strategies, breaking them down in detail, and answer any questions you may have. So an S Corp. So let's talk about, while I'm sharing my screen here, and I have my notes just to make sure I touch base on everything. Disclaimer. So here we have, let me go ahead and share, perfect. So an S Corp. An S Corp is essentially an entity. It could be an LLC or a C Corp that made an election to become an S Corp, okay? This bubble represents an entity. Now, this is you. And essentially you are either, if you're watching this video, you're either a sole proprietor, which means you're just earning 1099 income or just other types of self-employed income without any entity structure. Or you're an LLC, specifically a single member LLC. Now I'm going to go over a separate video on why I don't recommend S Corps to be partnerships and breaking in that down in detail, because that's a whole nother beast. So this video I'm going to be specifically going over single member LLCs. Spoiler alert, don't recommend partnerships to be S Corps, and I'll explain in a separate video why. So subscribe to make sure you get that content as well. So here you have, I'm going to be going over sole props, and earning 1099 income, or if you're already a single member LLC with no election. So what's happening is, for your tax purposes, you are reporting your income on your 1040 on Schedule C, okay? And when you do this, you are subject to Fed, state, local if applicable, and self-employment taxes. What is self-employment taxes? Another synonymous term is called FICA, and it's pretty much Social Security and Medicare, okay? Now, I break this down specifically because this is where the savings will be. And I'll go through an example in a moment. Right now, I'm just trying to explain what's currently happening in your world. If you're a sole proprietor or single member LLC, you're getting 1040, reporting all the income and expenses on your Schedule C, and you're pretty much, any profits that are left over on your Schedule C are being subject to federal, state, local, and self-employment tax. The quadruple whammy, so to speak. So now we have an election that could be made from your single member LLC to an S Corp. Now I mentioned C Corp up here because there are scenarios that I've come across with clients where unfortunately they were convinced by their previous either professional or attorney or someone, or they just saw TikTok or whatever the case may be. They set up a C Corp, and that's a horrible idea. You can still get them into the S Corp. So that's why I mentioned C Corp. So if you're watching this, you have a C Corp, you don't know if it makes sense to have a C Corp, there's still hope for you. Now, single member LLC, an election is being made, a tax election, I should say, with the IRS to be taxed as an S Corp. That's all it is. It's a tax election. Nothing changes in your state. Okay, whatever state you are in, whether it's Texas, Maryland, where I'm from, Virginia, they honestly don't care what type of entity you are. Now, there may be some forms that ask you like, hey, are you an S Corp or not? But they truly don't care. Some places do. For example, Washington, D.C., because I have a lot of clients in Washington, D.C. Unfortunately, they don't recognize the S Corp, so they don't recognize the pass-through portion of it. And I'll get to what pass-through means in a moment. And so they recognize you as a C Corp, and then you have to pay C Corp taxes. Yuck. The good part about that is that in Washington, D.C., you're able to take a tax credit on the taxes you paid at the corporation level. Okay, so single member LLC or C Corp can be an S Corp through a tax election. Now, why did I leave off sole proprietor for my explanation, if you caught that? I left off sole proprietor on purpose. And the reason why is because a sole proprietor cannot make an election to be an S Corp. It needs to be some sort of entity structure. So it depends where you are in your journey to really determine whether you need an LLC or not. A lot of times new business owners, and I give out a crap ton of free content for new business owners, so double check my other videos for that. But the component of an LLC is simply for asset protection. Okay? That's why you set up an LLC. And without going down that rabbit hole, which I can talk, there's other videos already on this. LLC is set up for asset protection, not for tax purposes. So depending on where you are in your journey, sole proprietor may make fee right now, but eventually you want to potentially get an LLC as your profit grows. And the profit that I want to see to start considering an S Corp is $75,000 profit. So that means you have your revenue, money that's coming in the door, minus your expenses, money going out the door, then you have your net profit. So this is the number that I'm looking to be around I would say 70 to 75K mark. Why do I have that number? Some people say 30K, some people say 40K, then people are trying to figure out why that number is. I have my own justification, and I'll tell you why right now. And the reason why is because there's admin costs that people don't associate the savings with. It costs money to run a business, shocker. Admin costs for an S Corp specifically is you have to pay a payroll administrator. Yes, you have to run payroll. We'll get to that in a second. And excuse my horrendous handwriting. Payroll is something we have to do. Yes, this is payroll. Let me try that again. That's why I'm an accountant, not yeah. All right, payroll. You have to do a business tax return, which is going to be called an 1120S. You have to do LLC annual registrations if you don't already, etc., etc. So there's other admin costs that comes associated that will eat into your savings. It needs to make sense. It needs to make sense. Okay. So 75K is one of those requirements that I like to see first. And in addition to that, I also want to see this 75K number. We'll do 75 as an example. 2 years in a row, year over year. Ideally. And the reason why is because there's a lot of times where I see a business owner and they are just making money, which is fantastic. Their first year, they make fantastic money. And then the second year, it just goes downhill, whether it was related to economy conditions or if it was related to just whatever industry they were in. It could be they just lost motivation, something happened. So there's a lot of risk in this scenario. Loss of contracts, key contracts, if you have contracts with other companies. So there's so many scenarios that can happen. And so at that point, you're paying all this cost for admin, right? And then you have to dissolve the LLC. That was an S Corp, or dissolve the S Corp, I should say. And there's cost to that as well. So now I have this kind of like thoughtful, like, hey, I want to see this year over year, not just your first year. There is a few exceptions that I made, And the reason why is because they're just making so much money that carries over year over year over year. I'm talking about several hundreds of thousands of dollars, which is fantastic. It just made sense to go to the S Corp immediately. It's saving them a bunch of money. But ideally, a majority of you, I would like to see the number. Okay. Now, that's the fundamental structure of an S Corp, of how it works, when does it make sense, all that good stuff. Now, you may be asking, okay, why do I still need an S Corp? S Corp saves you in self-employment tax. That's really what it comes down to. And you know what? What I'm going to do even better is let's just break down apples to apple comparison. So just put a line here in the middle. So on the left side, we're going to have if you're a sole proprietor, or single member LLC. Okay? Which we know from our discussions above is reported on your Schedule C. Okay? And then on the right side, let's have the S Corp. Now, for illustration purposes, let's go ahead and do $200,000 of profit. Profit, guys. Okay, not revenue, profit. There's a difference. After your expenses, what's left over? So $200,000 of profit. Now, $200,000 of profit is going to be subject to federal tax, state tax, local tax if applicable, local tax, and lastly, self-employment tax, which we know from above is a combination of Social Security and Medicare. When you tally all this up, it's going to be a good chunk of change. Let's say it's about $80,000 in taxes. And of that $80,000, $30,000 is self-employment tax. And self-employment tax, let me even break this down even further before going any deeper on that. How is self-employment tax calculated? Well, here you have your regular W-2 employer, and then you have a W-2 employee in a regular scenario. You can see in your paychecks for your W-2 employee from your pay stubs, Social Security and Medicare has already been taken out. And if you add it up, it's about 7.65%. Okay? And then the employer actually has to match that amount of your Social Security and Medicare for employer portion of Social Security and Medicare. And so 7.65% here, 7.65% here, and then you tally this up, it's about 15.3%. And then the employer is responsible to submit that to the appropriate agencies, right? So 15.3%. That's where that number is coming from. So 15.3% of 200K profit, you're looking at around $30,000. Okay. Why 30,000? Because when you're self-employed as a sole proprietorship or single member LLC, you are responsible for both the employee portion and the employer portion. You are one and the same, which is, catches so many people off guard, so many people. And that's why I'm creating this content. So self-employment tax, $30,000, right? 15.3% of the 200K profit. So that's the example of what's going on right now in your world. Again, just for illustration purposes. Now, let's compare the exact same scenario, but for the S Corp. So we have 200K in profit. And now we're going to break down the two types of compensation that happens in the S Corp. The first one is a W-2. Yes, you have to run payroll. I mentioned one of those things that we have to do in the admin portion. Payroll is something we have to get done. Now, what determines your salary that you should pay yourself, because now you're going to ask, oh, well, what do I pay myself? Your tax professional should help you with calculating that number. For this example, I'm going to use W-2 on 200K profit, $70,000 of W-2. Now, you're paying yourself $70,000 of W-2 from your S Corp because now you're considered an employee of the company, okay, when you set up an S Corp. You're an owner employee, you're an officer, okay? So it's called officer's comp on your tax return. W-2, $70,000. This $70,000 is going to be subject to federal taxes, state taxes, local, and yes, self-employment tax. So you do have to pay self-employment tax here on the W-2 side. Now we have the second form of compensation. The remaining portion is going to be called an owner's draw. Another way to say it is owner's distribution. They're synonymous terms, shareholder distribution, however you want to phrase it from the technical perspective, it's all the same to me. And what an owner's draw is simply a transfer from your business account to your personal account. That's it. It's just a bank transfer from your business account and to your personal account. Or it could be ATM withdrawals. It's pretty much you extracting cash out of the business for whatever you want to do, right? For personal reasons. That's an owner's draw. Now it's very common that businesses that are starting out, they need all the money they can get to pay for their mortgage, their bills, their cars, whatever the case may be, for their personal expenses, right? So in this example, we're gonna do an owner's draw of the full amount of the difference. So 200 minus 70, it's 130,000. Okay. Now $130,000. This owner's draw is still subject to federal, state, local if applicable. This is where the magic starts to happen. Everything I said comes up to this point. $0 in self-employment tax. This is where the magic happens. Now, on $130,000, you're looking about 15 and change. I would round up to 20. So you're going to be saving, because when we pay these two amounts, you're going to be paying around 60K in taxes. Here's an example. You're going to be saving about $20,000 in taxes by being an S Corp, which is a chunk of change. $20,000. What can you do with an additional $20,000 that's back in your pocket? Maybe hire that employee, maybe do some marketing, reinvest it back into the business. Maybe it's going on that vacation you wanted. Maybe it's putting a down payment on a potential house. I know houses have increased in price, but it's something that you can put towards a next home. $20,000 into your retirement. I mean, there's endless things you can think of what to do with your money, right? And this is just one strategy. This is what the people don't understand is like a true tax advisor, true tax person that you're working with is going to come up with multiple strategies, not just one. This is just one. And one strategy alone can save you $20,000 in taxes. That's phenomenal. That's a big deal. So that's why people become an S Corp. Now, you may be saying, well, okay, if all the savings are on the owner's draw side, why don't I just take a salary of, let's say, I don't know, $1, and then $199,999, $199,999, pretty much the remainder amount is going to be my owner's draw, and I'll save a boatload in self-employment tax and just pay almost nothing. That sounds like a way better idea, right, Kevin? Wrong. You need to have reasonable compensation. And this is this is such a highly audited item of reasonable compensation. And so when it comes to S Corp, so working with the right tax to guide you is super, super, super important. I keep bringing that up because it's super critical that you do. And so by doing it in this scenario, you would not only get flagged by the IRS for unreasonable compensation, you also get your S Corp revoked, and you will also likely have to pay penalties and get back to that self-employment tax. You probably have to pay the full amount plus penalties and interest. It'll be a nightmare. And so don't do that. Let's just recap. When to consider switching to an S Corp. So if you're profiting, again, that word profiting, not revenue, profiting $75,000 or more, and you're doing that year over year. Another scenario when you want to consider switching is if you, I would put an asterisk to this, if you truly have a business, okay? If you're 100% or close to 100% into the business. Why is that important? Because there's scenarios and prospects that I've spoken to that have a W-2, they're making really good money already, let's say $150,000 from W-2, maybe even more. I'm trying to think of a specific client that comes to mind. So they had a W-2, 150K, and their side income was making, I think 200K net. Side hustle. Crazy. And then the savings just depleted because of the calculations. If you have another W-2, it just it factors into your tax savings, so the savings actually decrease significantly because we're already contributing self-employment tax from their W-2 side, which helps. So that's another scenario that you need to consider, and if this applies to you, the right professional should be able to guide you. Okay, so something to consider. If you're full-time in your business, you're making more than 75K year over year, I would consider an S Corp. Another scenario of when to switch to an S Corp is getting, I would say, stacking strategies. Now, I'm not going to go over in this video what other strategies are there. Subscribe and I'll go through them, breaking down one by one. But what do I mean by stacking strategy? I'll give you one example. There's definitely multiple. One example is the Augusta rule. Now, you may be Googling Augusta rule. That's fine. Augusta rule, pretty much at a high level, is a strategy you can utilize to lower your taxable income, okay? And the only way you can use the Augusta rule is if you have a corporation, hence the S Corp. You can't do it as a sole proprietor. You can't do it as a member LLC, so you have to have an S Corp. And so this is just one strategy that the S Corp kind of unlocks other types of strategies that you can do to reduce your taxable income. This is just one example. There's many others that unlock when you become an S Corp. So now you're able to stack strategies. And then lastly, what I'm going to do, I say 1, 2, 3, 4. There we go. The last one, number 4, is going to be reduction of audit risk. So yes, I did mention if you have unreasonable compensation, it increases the audit risk. If you don't know what you're doing over here, trying to be super aggressive, pay yourself $1. I had a client, who literally paid himself $0 in W-2, $0 in W-2, and the rest of it he took on his draw. He's like, that's what the savings are. I didn't take him on as a client. I should say that was a prospect. Yeah, that was not the scenario. But if you're doing that, and number 4 is going to be reducing your audit risk. So you're actually 10 times, your audit risk decreases 10 times when you go from a Schedule C to an S Corp of being audited. And there's many reasons for that. Schedule C is one of those higher focused forms on your 1040 that are highly audited versus 1120 as a business return. It goes down significantly. They're kind of expecting you, if you're becoming an S Corp, that means you're a legitimate business. You're not just trying to get away from the tax system. You're actually trying to contribute in So it reduces your audit risk is pretty much what I want to say. By 10 times, which is great. So that's another reason to consider an S Corp. Let's see, what else do I have? The last thing, I guess, when it makes sense, or one more keynote to say is deadlines, right? So March 15th is typically the deadline to become an S Corp. Now, we have scenarios that we've constructed in our business to get a late election S Corp approved, backdated to January 1st. The true tax professional could be able to help you. It's a process. But ideally, the deadline is March 15th. But if you're working with the right pro, you have the right setup. I should say also, not just working with the right pro, your scenario also has to make sense. For example, if you're a sole proprietor, okay, if you're a sole proprietor and you don't have an LLC, you can't backdate anything to January 1st because there's no entity structure to backdate. So you have to definitely have a single member LLC that's already been created. Anyways, deadline March 15th, but with the right person, you can do a late election and get that approved. Right now, we have a 100% success rate at our firm on doing any late elections. The latest I've ever done it was like December going back to January for the same tax year. And that's the S Corp. That is it. Let me go ahead and stop sharing my screen. Alrighty. Huh. All right. Well, I can't figure out how to stop sharing my screen. But hey, if you're in the neighborhood, if your business is making $300,000 of profit or more, or you're expected to get there pretty quickly, or if you're a W-2 earner earning more than $500,000, feel free to book a call with our team. We have various clients from industries, from W-2s, from physicians to doctors to surgeons, insurance agencies, you name it. We have various industries that we work with. We've saved them. We're on track to save our clients over $1 million in the month of May 2025 alone. When I was looking at the numbers earlier today, we saved our clients $303,000 in taxes in just May, in just 1 month. So we're getting we're going to hit that $1 million mark of tax savings pretty quickly. Maybe even, our goal for 2025 is to save our clients $1 million. I think we're blow past that number. So if you're interested in, working with a true tax advisor, not just once a year, but throughout the year, feel free to book a call if you're earning, if you meet these thresholds. With that said, hope you have a fantastic day. Thank you so much, and take care.